Major support for these programs is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank, Chase Commercial Term Lending. Additional support is provided by AVR Realty Company, LLC, Briarwood Organization, Bruce Mosler, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, Chelsea Lighting, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova Burns and Gian Tomasi, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, Corman Communities, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, Meridian Capital Group, Newmark Knight Frank, Sterling and Sterling, SJP Properties, Stonehenge Partners, the Wickoff Group, Urban American, and Ackman Ziff Real Estate, Ariel Property Advisors, Eastern Consolidated, Essex Capital Partners, Goldman Properties, Moynihan Group, Musk Development, RAL Development Services, the Spandrel Group, LLC, Rosewood Realty Group, Terra CRG, Triangle Equities.
Everybody wants to own real estate. People have the opportunity of buying real estate by owning shares in real estate investment trusts. So what are the best real estate investment trusts? What are happening in that market? I don't know all the answers, so I've assembled 4 people who really understand what's happening with the state of REITs, or real estate investment trusts. My guests today include Anthony Pallone, Executive Director at JP Morgan Securities, Krupal Raval, who is Vice President of Capital Markets at Alexandria, Glenn Cohn, who is the Executive Vice President and Chief Financial Officer at Kimco Realty, and last but not least, the man who has 2 lives, my friend Tom Lydon, who's the President of the City Investment Fund and a member of the Board of Home Properties. So since wait, you're the senior citizen or I'm the senior citizen? We're not really saying.
So just had a birthday. So.
Okay, I had just had a birthday. So here's the question. You've been involved in banking in lots of areas for many years, and now you're a member of the Board of Home Properties. How do you and how do people in the world perceive the REIT? Is a REIT a good investment today? I mean, you were talking before about the numbers and everything this year, REITs versus the public market.
Well, until recently, the REITs had really outperformed the public markets. Now, of course, it's been a strong first quarter in the S&P and other markets around the world, but I've been involved in REITs since 1974, when you had the public REITs were primarily construction lending REITs, and I worked for Chase Manhattan Bank and was involved at Chase Manhattan Mortgage and Realty Trust, and there were about 20, 30 of those REITs, all who faced severe problem in the 70s when you had a downturn. And those were fairly heavily leveraged.
But today we still have mortgage REITs in a different mortgage and finance REITs.
They are, and that's a totally different animal to people who are thinking about investing in REITs. It's a totally different animal when you're talking about a mortgage REIT who's investing in mortgage securities, most likely, perhaps doing some lending, versus the REITs that are here today who are primarily equity REITs, specializing in product types, not heavily leveraged, very strong management teams, very transparent, raised capital, and specialized in really maximizing real estate value at the property level, and then passing that in the form of dividends and hopefully capital appreciation.
You live, eat, survive as a REIT expert, as a REIT analyst. How do you look at, and Tom just brought up an interesting topic about the mortgage REITs and the finance REITs. How do you look at those entities?
Well, the mortgage and financing REITs are really, they're like finance companies effectively. So, I personally don't spend a lot of time on those because they're much more akin to, again, finance companies, almost like an alternative to a bank if you're a borrower. And so a lot of those are covered by our specialty finance group. When I look at the more typical equity REIT, as we call them, we look at these as really large portfolios of high-quality commercial real estate. And they're run just like any other company in corporate America would be run, with a strategy, with some sort of a value add that they're bringing to shareholders. And investors get the benefit of liquidity and being able to buy and sell these companies like they would any other stock.
Now, you look at all different types, and one of them is Alexandria. Tell my audience what Alexandria does.
So we're an office REIT with a specialization on biotech real estate, which is basically the type of real estate that biotech companies, pharmaceutical companies, and the life science industry, broadly speaking, looks to do their research in. So all the research that's conducted to come up with innovative therapeutics, whether it's drugs to help cure disease or prevent disease ultimately, that's the kind of research that's conducted in our labs.
Now, my question is, do you have companies, I know you have this fantastic facility in New York, the new facility. Do you have companies there who are startup companies who are, who really are not well capitalized?
It's going to come down to the actual individual real estate where we own. What we've done is we've created different products where you can have startup companies, or kind of the
incubator?
The incubator that basically provides the opportunity for companies that we believe are going to be the next generation of the next Eli Lillys of the world, and you definitely need that. So in order to be able to foster that kind of environment where a company can grow from a kind of a younger stage and grow to become the next generation of the Eli Lillys or the Genentechs of the world, we do foster that kind of innovation. But the fact of the matter is that since we have a team of scientists on staff that help us understand who those next generation companies are going to be, we're not trying to take on any unbelievable risk in order to be able to provide that space. We want to provide it for the best of the best.
Now, but let's talk about risk. You're charging rent.
Mm-hmm.
So part of the risk is the tenancy risk, which he lives with all the time on tenancy risk. So, but you're not. Are you giving free rent?
What we do is we underwrite very rigorously. We underwrite like a venture capitalist would underwrite the same kind of equity investment in that company, because the way we look at it is that this is a really premium space, premium price product, where there's kind of a line out the door, frankly, for people who would want to be in an Alexandria facility. So the fact is that we want to be very judicious in making sure that we have the right tenant in the space, as opposed to just simply having that space occupied. And the fact is that it's a kind of a small component of the total square footage we own. We as a company have over 13 million square feet, and this is a very small percentage of that total. But nevertheless, it's an important opportunity to be able to have the companies that are going to be what we perceive as going to be the best growth stories going forward.
And the largest regional shopping center REIT in the country. Now, you look at tenants in a different way. Can they pay me? That's one. And what else?
Well, again, when we look at our portfolio, it's very, very diverse. Our largest tenant, and we have 940 properties, our largest tenant is Home Depot. They make up only 3% of our rents. When you get to our 10th largest tenant, they make up only 1% of our rents.
Which is great, because when a Borders goes out of business, or a Circuit City, you have a loss, but you don't have that great of a loss because of the non-dependency.
That's right, and our boxes are a lot different than Alexandria's, because they're you can vanilla box something. It's not as specific. You don't need to put as much money into that box specifically. In a lot of cases, our tenants will pay for a lot of the work. So rents are dependent. You can buy up rents if you want, but we've tried to take it where the tenants have put more money into the box than we have. So we've kept the rents lower, and that really keeps it as really real estate versus credit.
Now, what I was saying to you prior to the show is I was noticing on your investor presentation that you've taken in the shopping centers in these large areas some of the parking lots or the pads and made more utilization of that. Let's talk about that.
Yeah, I mean, restaurants, again, you think about the internet, you know, there's a lot of exposure to the internet and what can go on, but one of the things that is not so exposed to the internet are restaurants. So we've taken a lot of our out parcels and we've put restaurants on them, whether they be Applebee's and others like that. So it's a good way to utilize small amount of space, but it generates a fair amount of rent. Gas pads are another one.
Now, with regard to that, are you taking, who's the end guarantor on the lease? Is it the master franchisor or the publicly held company, or is it the Anthony Pallone who operates an Applebee's?
It's really both. Sometimes you'll have the franchisor or the corporate store, and sometimes you have the franchisee. But we've done deals with multiple franchisees. As a matter of fact, we even put a program in place more recently where we've gone to certain franchisees like Dunkin' Donuts and gotten corporate stores pre-approved for space that we could put an ad in the window so the franchisee can go ahead and know that's a space that's already approved by their corporate office.
Now, the only negative, and you know, certain this would happen on your companies, on the incubator companies, is that it's difficult for some of these franchisees to sometimes get financing for these locations.
It's very true. Sometimes the corporate office will provide some of that. Again, we can do the build out and we'll help sometimes as well. But you know, it really is going to be dependent on the bank starting to, you know, provide capital to the smaller tenants. That's really the biggest challenge we see in our sector today is really the small shop space.
Let's talk about, you know, I mean, Tom sees it being on the board of Home and everyone else. How are the, you know, 2008, 2009, I remember when I had your colleague, my friend Mike Papagallo, on the show, and he was saying, yeah, you know, the banks, when we had to tell them that we had difficulties, they were angry at us. Are the banks back out there? Are they providing financing much easier today? The CMBS market, where are you getting most of your money? Where's Home and where's Alexandria?
Again, we're you know, we're a large public company. We're an investment grade credit. So the capital markets today for investment grade credits are pretty wide open. The bond market is open, and you can access 10-year capital, you know, somewhere around 4.5%. There's a perpetual preferred market. We just did an issuance at 6%, really permanent capital at 6%. It's very different if you're not rated or a small investor. I'd say that it's still somewhat of a challenge. The banks are trying to do more. You'll see JP Morgan and Bank of America out there with lots of advertisements about small market lending, but it's still a challenge.
Yeah, I think I would echo those points exactly. I think that the
Are you investment grade?
We are investment grade, and I think that one of the things that you see with the REITs, generally speaking, is that the REITs, in order to even become public, there's a very high barrier to even become a publicly traded REIT. So when you look at the caliber of the companies that are REITs, and especially if you're an investment grade rated company, you know, the access to the capital markets is much more profound than you would have on the private side or even if you're on the smaller end of the spectrum. So I think that, you know, companies like Kimco, companies like Alexandria, companies like Home are kind of in a very unique position in order to be able to access, you know, tremendous amounts of capital.
I think the last 12 months, and noticing Home does not have a investment grade rating for its debt. It's on the cusp of that, but they were able to refinance and get a much more favorable line of credit, able to do a 10-year term loan, able to raise capital pretty easily. Now it's in the multifamily area, which is less
preferred
volatile.
asset class.
Yeah, preferred asset class, and you know, very stable type of earnings. But I'd say the last 12 months, you know, the banks have changed their attitude quite considerably.
Now, I know that Glenn did a very successful refinancing of your syndicate. How big was it?
Yeah,
Over
we
$1 billion?
put together $1.75 billion, and it was very well received. We had 28 banks that joined it. We had over $2.8 billion of commitments, and we're able to price it pretty tightly. The other thing I wanted to mention to you is you asked about the CMBS market. So the CMBS market, again, the secured market, it closed for a while, and you know, after the summer in 2011, it's back open again, and you're also starting to see there where spreads have come in a bit. And you can start to really access that market as well if it's the right property type.
How do you look at when you're evaluating companies? How do you look at the debt structure? I mean, this subject of this perpetual preferred, and how do you and your colleagues at JP Morgan feel about to give a positive report on a REIT?
Right. So And when we look at the capital structure, I mean, we could talk ad nauseum about all the ways we would analyze it, but the general idea is less leverage is good because most of these companies want to grow over time. So the idea that you have capacity in terms of your balance sheet is more compelling to us. And follow up on this discussion about what's been open in terms of the debt market. What I think is pretty interesting here is you've had term debt available at very attractive rates for most of the REITs over the last 6 months or so. And what it's done is it's helped add a little bit of a tailwind to the earnings of these companies. And so if you look at 2012 earnings estimates for most REITs and what happened to those estimates over the course of 2011, even as the macroeconomic backdrop was shifting down and people were getting much more worried about what the economy was going to deliver, the average REIT's earnings estimates for 2012 didn't move. So their ability to access low-cost financing has really helped with a bit of a tailwind. Because most companies are rolling debt this year with, call it something a little bit over 5%, and most of the debt that it's being replaced with probably has a 4 in front of it. And it's really helpful to these companies.
Right, it's increasing their earnings and it's helping. Now, my question is, one of the other benefits of REITs is that, you have the liquidity and you can transfer, and you also have dividends. What kind of dividend has Kimco been paying?
Well, our current dividend is around 4% on yield based on the current stock price. It was recently raised. We raised our dividend 5.6% at the beginning of this year. And again, it's based on cash flow. As long as we continue to increase occupancy and same-site NOI growth, then we're hopeful that we'll continue that trend towards an increasing dividend.
Tommy, what's Home's dividend?
Home's about 4.6, 4.7. They just raised their dividend also. So, but I think when you look historically at REITs, actually we're in a time period when yields are fairly low. There's been periods of time when REITs have yielded 5.5%, 6%, good, solid REITs. And it'll be interesting to see if and when interest rates rise.
I think the question is when. They are going to rise.
Well, again, it's none of us are probably good at guessing. It's political in nature. But then will that affect the ability of REITs to raise equity, to compete for capital, because they've been very effective in raising capital, equity capital, the last 18, 24 months, billions and billions of dollars raised and invested. So that's been pretty successful. And when you look at the baby boomers retiring, and I'm in that class, you're in that class, Mike, from the standpoint of, are you already retired maybe? Okay. No? The answer is that getting dividends of 4 to 6%, and then if you go into the preferred, you can get 6 to 8% depending on the quality of the company, and you have them in a retirement account. That is very, very attractive income for retirement accounts as compared to what's available in the marketplace today. So I suggest that I think REITs will be, if they have the ability to find investments that can generate the income, and that's always the challenge, I think they'll continue to grow.
So I have a double question. What's your yield today?
Our yield is we're actually in a very unique position because we retain as much cash flow as possible because we have so many compelling development opportunities. So we're kind of in a unique position from that perspective. Our dividend yield is just shy of 3%.
Now, so here's a question. I hear, Tommy's talking about opportunities. I hear dividends. Do you see different opportunities for all of the REITs? I mean, there was a study that recently came out by a senior housing group with regard to, especially with what Tom just said, the aging citizens, more baby boomers, people living a longer period of time, which has effect on all of the business. Do you see perhaps a company like a Home, or do you see some of the companies that you follow who are in the residential market going to the next area of going into the senior housing market? That's one question. Do we see in your market, because you have one segment, a large segment in the market, that perhaps you'll advance and go to another area of the healthcare market with regard to having ownership of for-profit hospitals or or medical offices? Kimco, who's had different investments in different areas, do you see this situation? So, I mean, as a REIT analyst, do you like companies to to increase their world?
Not necessarily.
Not at all. I don't.
No, I mean, most REITs have a certain core competency.
You think I was going to be that quiet? I mean, right.
Where you do see some diversification, though, is in fact in the healthcare space, where companies that have historically been in assisted living are moving to like life science or to medical office buildings and diversifying across the healthcare space. But you're not seeing them leave healthcare and go do straight up office buildings or something like that.
In reality, if you want to look at going back a number of years ago, when we had these senior housing REITs, they went bankrupt. A lot of them, Sunrise, I was noticing they built all these great facilities. They have one in Chicago, a water tower, that the distress that is being acquired for next to nothing because of the difficulty. Do you see that? I mean, or how do you look at an entity like a Vornado? I'm not talking specifically on Vornado, who are out there and saying, hey, I'm going into a distressed debt fund business. I mean, is that something?
If it's complementary to the core business, so one area where you see it, where you could say, okay, these guys are crossing over and it makes some sense, is in companies like a Vornado or an SL Green, or even Kimco historically, where you either did office buildings or you guys were primarily in the suburbs doing shopping centers, where you say, wait a second, we need to be in New York City street retail. For an office landlord to take a more holistic view of New York City and say, okay, we own the space up in the tower, but we could really do something special with retail, and there's enough of this stuff that it's a business in and of itself. Like that makes a lot of sense. Or seeing guys like Kimco do the same thing with street retail in high density areas. But to see someone just completely change their stripes, it's going to be tough to convince the institutional investment community that they'll be successful.
I'm looking, and we brought up some good ideas. If you're like home is a great residential rental REIT, and since they're in that business, and in the communities that they're near, couldn't they be in the senior housing business?
They could conceptually, Mike, but I think again, the great thing about the public markets is the discipline that and the chief executive officers and CFOs wouldn't agree on this, but the great discipline from an investor standpoint or from a board member from where I sit is that they really keep these management teams on the straight and narrow. And if you're going to veer off, you're going to have to do something pretty successful. And I'd say, again, certain REITs have tried different new things, but I'd say in most cases they've had to withdraw and do something else. Now, in the case of home properties, their diversification was to move from just buying C properties and improving them into B to getting into the development business of building A properties, but only in markets where they have very strong management presence. So.
But relating that, and let's follow Kimco, I mean, there hasn't been much retail, new anchor shopping centers being built today. So but you're growing. Now, part of your growth has been done by going to Canada and going to Mexico for your expansion. Couldn't home properties increase their market the same way that these people came into New York 3 years ago? They weren't here. They're in Cambridge and they were other places. I'm not saying diversification. I'm saying increase location-wise.
And I think from our standpoint, what we tried to do was we did go more international, both north of the border and south of the border, but in the product type. The dedicated REIT investor really wants you to stick to your knitting. Our knitting is neighborhood and community, big box shopping centers. We did do some other things, and we built up a portfolio of close to over $1 billion at one point of other investments. The fact is we've gone through, we are in the process of really liquidating all of that, and that'll be down to, $250 million hopefully by the end of this year. So focus is very important in this business.
But what I'm saying to you is expansion of your own core type. You came to New York. There are other expansion markets that you could have. I think when your business, it's really near the centers of excellence and medical centers and research over there. You could be anywhere. You're in 44 states right now, but you could be over there, and maybe you could do some more business in Brazil, perhaps, or other markets, and you could find new states that you're in.
Yeah, geographic expansion in your area of expertise, I don't think the analysts have any issues with if done in a programmatic
Wait,
way.
let's ask the analysts. Do you have?
I mean, I think in reading the reports they write, for example, you take a very excellent company like UDR, used to be called United Dominion. They had a portfolio basically in the southeast and southwest, areas of very high supply, very volatile rents, and they have done over 3 to 5 years a total change in the portfolio by buying in some of the areas like New York, like DC, like Boston, and have changed the composition of the portfolio. And I think the stock has performed, and the analysts have bought into that.
UDR is a great example because you look at the apartment REITs, say who has the highest multiple, who has the lowest cost of capital that makes their business easier to execute on, and say what do I need to do to get that type of capital cost and that type of following. And for UDR, the couple of holes in their portfolio were pretty obvious: Boston and Manhattan. And over the last couple of years, they've filled them quite nicely, and you could see investors respond to that.
We went public in 1997, and since 1997, we've had a very focused niche capital allocation strategy, in the sense that we only want to focus on the cores of focused on the coasts. And so when you look at our individual expansion, you look at Manhattan as a phenomenal opportunity. We currently have 300,000 square feet, but we have the opportunity to grow that by another 800,000 square feet. You look at being in Kendall Square, which is probably the biggest and best biotech market there is. We have the opportunity to grow over 2 million square feet there. So in terms of our core growth opportunities, Alexandria has always been very focused on these coastal markets, and we're lucky to have growth within our individual core markets.
From our sector, when you think about, you mentioned that there hasn't been a lot of new development, and that's true. That's actually been a real positive for our sector.
Right, it's helped you.
Yeah, I mean, we filled up most of our big boxes. Our big boxes are over 96% occupied, and really what you have now is filling up the small shop space. And with no new development, it just makes it that much better, and it gives you that much more ability to move your rents.
But what you've been able to do, I mean, as a really good retail REIT, is that you've been able to adapt. As I said, one time there were record industry, and one time there's a book industry, and the world changes, okay? And 20 years ago there was no need for an Alexandria because we didn't have that biotech business, so everything changes. 30 minutes goes rather fast, but I really think we got some really good insight on what's happening in the REIT industry, why it's a good time to invest in REITs, and deal with good ones that Tony selects from J.P. Morgan. I'd like to thank Anthony Pallone, Kripal Raval, Glenn Cohn, and Tom Lydon. See you next week.